Today, Enbridge announced earnings. They had their Q3 2024 earnings, and I think it really tells us a lot about this company and about what we as investors can kind of expect from them. So today, in this video, what I really want to do is show you on the screen here what exactly is happening with Enbridge in this third quarter. What do their revenues look like? What does their EPS look like? And more importantly, for a lot of us, why? What have they done right? What have they done wrong? How can that help us as investors understand both our long-term thesis in this company, understand if they're still going in the direction we want them to, and understand how this investment is going to hopefully play out. So on the screen right here, you're going to see we're throwing up the Q3 investor relations presentation they have for us from the earnings report. And so I'm just going to sort of scroll through this. So we have our legal notices up here. You have the agenda they went through, and let's start with the third quarter updates. So they mentioned they had some strong third quarter financial results. Their revenue that I have available to me here, it shows that them sitting at about $14.8 billion of revenue with 0.55 earnings per share adjusted. And we won't go too deep into those numbers and whether or not they meet sort of what analysts thought and all that, because a lot of that has to do with what is happening right now, what analysts were expecting, and the small differences as a long-term investor isn't going to change much for me anyways. But what really will change a lot is whether or not they're accomplishing the things they wanted to accomplish, and whether or not they're getting that revenue and those earnings in ways that I think is going to work out in the long term. So we're going to talk a little bit about their execution and operations. So strong utilization across the asset base. One of the big things that people warned me about when I started investing in this company was that they might be out of luck with the new Trans Mountain pipeline, that maybe they're too dependent on a single resource or a single area, that there was going to be extra drilling that's going to totally kill their operations, all of this. And seeing that actually they've done really well recently and that they've continued strong utilization across their main line, it shows me that they're still going to execute over time. You also see here, they closed a big acquisition. Their U.S. utilities acquisitions are now all complete. They were talking about this for a while. They wanted to own these U.S. utilities. They're done. They've closed these acquisitions. They own these assets. And now they can actually make some money from this rather than continuing to spend money and have all this debt that they need to service. They also closed the acquisition of additional docks and land adjacent to their Ingleside Energy Center. They talk about that a little bit later. And they're on track to place $5 billion of secured capital into service in 2024, which basically means they've already secured the capital, they have the money, and they're using it. They're using it in ways that should be beneficial for the business. They've shown a 15% interest in the DBR gas system. They've got new 815 megawatts in their Sequoia solar project, and they've got participation in phase 3 of Fox Squirrel Solar. So basically, they're talking about all these investments they've made in renewables as well as natural gas. Both things that I've mentioned, basically every time I've talked about oil and gas companies, are potential opportunities for long-term investment, just in case oil is at a lower price. They're able to use their current cash flows to invest in these things that might help them sort of balance things out in the long term. They've also got a sanction, basically a permit, to service the BP USGC operation in the Gulf, and they've got $7 billion added to their secured growth program. All sorts of cool stuff. Basically, and look, I was literally just talking about this. They've tried to make it so that they will succeed in all cycles. So they talk about their dividend aristocracy. As a dividend growth investor, awesome. You gotta love a dividend aristocrat. But it doesn't really mean much beyond the fact that they've been able to execute for 29 consecutive annual years. They talk about their 98% contracted / cost of service cash flows. Basically, they're working at capacity. They don't have extra space in these pipelines because of all the additional pipe that's been put in the ground. There's still enough demand and enough production that their pipes are constantly full. They talk about how they're sitting at investment grade, how they have negligible commodity price exposure. Basically, it doesn't matter what the price of oil is. They will be paid to transport that oil regardless. And they're showing a multi-year Earnings before interest, depreciation, and amortizations, growth of 7 to 9%. Solid, sort of high single-digit growth. But as somebody who's investing in a lot of dividend growth companies, high single digits is actually pretty good, to be honest. All right, next up, they talk about their positioning to serve gas and power demand. And a lot of this that they've been investing in is in Ontario and is down in the States. And you see the pipes they're showing on here. You see the areas in yellow and in blue. A lot has gone into. They talk about how they're within 50 miles, their network is within 50 miles of 45% of all North American gas-fired power generation. Basically saying they're in range that they could be the ones delivering gas to half of the gas power plants in North America. And they've got all of these, all of these assets in Tennessee, Utah, North Carolina, Ontario. And they've got all of these projects going up. They even talk about one thing I think is really interesting. The 200 megawatts they've got here to service data centers in Utah. There's no boom like the AI boom, right? And it's really interesting to see these guys showing, hey, look, we might not be a traditional AI player, but we're the ones that are powering the data center in the first place, that powers the AI, that powers the tool, that powers whatever we're doing with this, right? So really interesting to see that. They talk about their increase in natural gas storage. They talk about their underground storage facility. They're serving West Coast liquid natural gas. They've got the only underground storage facility in BC. Talk about increasing expansions, all stuff that I find really interesting. And I want to sort of point out the elephant in the room, this big sort of circle they've put up in the middle of the screen. They're projecting 20 billion cubic feet a day of gas demand by 2030. They're saying, hey, in the next 5 years, there's going to be so much demand for natural gas, and we're going to be there. We are within range of all of these power plants. We are going to be available with the supply and the capacity to deliver all of this natural gas. Really, really awesome stuff. They also talk about LNG exports, how they've been able to continue to serve the amount of LNG that needs to be exported, and how in Canada, at the very least, that they've got the wood fiber LNG, which is going to produce 2.1 million TPA of LNG. So basically, they're continuing to produce, they're continuing to grow. They're showing huge growth in the Gulf, huge growth in Canada, and basically they're saying it's going to be steady everywhere else. Now let's go down to the liquids. Obviously, huge part of this company is their liquids pipelines, and they've broken this down into two sectors. So first off, Western Canadian Sedimentary Basin. That's been a lot of what we talk about here on this channel. They're expecting to exceed the mainline volume forecast. If you're an Enbridge investor, I'm sure you know why this is huge this year. Trans Mountain Pipeline is online, and these guys are exceeding the volume forecasts. That's huge. They've talked about additional egress. So they've talked about basically more capacity, and they're talking about more expansion opportunities sort of in the region of the oil sands. So there's all sorts of stuff. They're continuing to produce. They're continuing to increase capacity, and they're saying we're going to continue to build out in the oil sands. We've also got the Permian Basin on the screen. They talk about record volumes. I've talked about this on the channel. Everyone wants to be in the Permian Basin. That's like where the money is in oil right now. They're making single day records. They closed an acquisition. We talked about this earlier. They closed an acquisition of docks and adjacent land. And you see that here, the Ingleside Energy Center, right? So they have this adjacent land that they've acquired right beside where they already were. They've acquired docks, so it's going to continue to make integrations. They're going to optimize loading windows. Basically, they're going to be able to get more oil onto more ships, which is going to allow them to export more. The quicker they can do that, the more they can be moving, the less they have to rely on storage, the less they have to worry about people coming in and out, better it is for them. Okay, GTM highlights. So connecting new supply to key demand centers and extending Permian gas value chain. Whew. Gulf Coast, they're talking about offshore pipelines. And you'll see that on the map here. We've got the Canyon pipelines. They're going all the way out to BP's, I can't say that word, Cascada offshore operations. They're saying they're going to spend about, I guess, $700 million. I don't know why it's 0.7 billion. It says it's backed by long-term contracts. They're aiming for the end of the decade to have secured backlog. Sounds pretty awesome. And they have the DBR header system, which they're showing there over in West Texas, almost into New Mexico, where they have their a new stake that they've acquired, and they're extending their natural gas value chain deeper into the Permian. So they've been doing awesome, and it looks like they're continuing to expand here. All the things that I see here just show more expansion. They're putting more in the ground, and they're making more from it. And then their utility. I mean, they're the largest natural gas utility in North America. They show their Ontario utility, right? It's growing. There's been really strong demand. They show their Ohio utility. They show their Utah utility, which is growing fast. Their North Carolina utility also growing fast. So much going on here. We're going to talk a little bit less about this, though. Renewables, something really interesting, I think, right? We've talked about this, how these oil and gas companies have the opportunity to be investing into renewables if they wanted to, and potentially use that as an opportunity to, I hate the word future-proof, because it implies that oil's not going to be around, which obviously if you're investing in this company, you should hope oil sticks around. But at the very least, it allows investors to place a little bit more confidence that this company isn't entirely tied to one resource. On the screen here, we're showing Fox Squirrel and Sequoia Solar. So two big solar projects. Fox Squirrel is in Ohio. Obviously, it's going to help serve that Ohio utility. They're talking about their long-term partnership with Amazon, right? So they have a buyer for what's going on there. They talk about their Sequoia Solar. This is down in Texas. Both of these, right, close to existing Enbridge infrastructure. They're talking about how they have partnerships with AT&T and Toyota, and how Sequoia is going to be one of the largest North American solar facilities by capacity. Awesome stuff. Now, let's get to the actual numbers here. So if we break it down, you're going to see there's a little bit of increase. I'm looking at the screen right here. You're going to see there's a little bit of increase above their liquids pipelines revenues, a little bit of increase in gas transmission, a big increase in gas distribution and storage, decrease in renewables, and eliminations are basically the same. So you end up with a pretty big increase year over year from last year, sitting at 4.2 billion compared to 3.8 billion from their pipelines last year. You're going to see we have some maintenance costs a little bit up, financing costs, good chunk up, income tax, a good chunk up. And so we end up only up a little at the end in distributable cash flow. DCF per share is actually down because there's more shares outstanding, and adjusted earnings per share is a little bit down. Let's keep going down here. Let's keep going down the look. Near-term outlook. I think it's really interesting. I saw that they've talked about how in December they're going to sort of give us some 2025 projections, but at the very least, this next little bit is looking interesting. Again, they're expecting those high single-digit numbers for their compound annual growth rate, lower single-digit numbers for earnings per share. They're saying that their interest costs are cutting on their earnings per share. They're talking about headwinds from tax legislation. Interesting. Medium-term outlook, they're saying 5% down the board with EBITDA, DCF, and EPS. They're just saying, 5%. We're going to be in the middle of that single-digit range. You shouldn't expect this to be like growing super fast. Honestly, the fact that it's up as much as it is this year is pretty impressive on its own. And it has a lot more to do with interest rates than it has to do with these guys actually being a huge growth company. Capital allocation priorities. Again, one of the things I'm really interested in when I look at this business in the long term. Balance sheet strength. This is something people talk about with Enbridge, right? They have so much debt. They have to buy all these things. They have to run all these things. We showed earlier just how much they're paying in interest costs. So having balance sheet strength is important for them, right? They're showing They want to maintain their leverage at 4.5 to 5 times debt to EBITDA. They want to maintain that. They're saying, hey, we're making enough money that this is important to us. We want to stay there. But they're talking about their capital recycling program. They want to keep that going. They want to keep their financial strength, their flexibility. So they're not planning on going above that. Even if there maybe is an opportunity, they understand that the risk, the sort of endemic risk to the company of taking on that much extra debt is not worth it. Sustainable return of capital. They want to keep their DCF payout range from 60 to 70%, and they want to show their commitment to shareholders by keeping that dividend aristocrat status. They've talked about this a couple of times now. They really think being a dividend aristocrat is a big selling feature of this company. They don't want to lose that status. They want to show, hey, we've performed consistently for a long time, 29 years, and we plan on performing consistently into the future. They also talk about further growth. They're showing like they have a serious secured growth backlog. So basically they've planned on this stuff. They've talked about this. They've, maybe they have deals in place. Maybe they have contracts ready to go, but they have a backlog. They're saying we're ready to keep going. They're going to prioritize no and low capital opportunities, right? So we talked about it. They don't want to take on a huge amount more debt right now. They've made some huge acquisitions. So they're like, okay, where can we expand a little? And they want to strategically deploy excess investment capacity. So maybe if a deal was budgeted at a certain number and comes in a little bit lower, they're saying, hey, we can still use that money. We can still invest that, but we're going to use it in a way that doesn't add to those debts. And again, they're saying, hey, we are doing everything we can to make ourselves investable at all points in the cycle. We want to be ready to go in all market conditions. We understand, like I talked about earlier this week, that maybe the market isn't great right now. There's a lot of fear of what's happening in the Canadian, specifically economy, but we are going to succeed no matter what. I think that's pretty huge. They talk about their scale. They talk about their diversification. They're saying, hey, we're a real investment opportunity. And that's sort of where we end the earnings, with the exception of this little section at the end where we talk about their secured capital, right? So it shows just how much capital they've got secured for all of these investments, which leads us to that total secured capital program, those $27 billion. So much on the sort of docket that they could invest into. But for right this second, they haven't, or at least, it's not the moment for them to do that because it would leverage them too high compared to their EBITDA. So now that I've talked about this, what do I think? And what do I think this earnings told us? Am I expecting big movements over the next couple of days or weeks? Do I think the stock is going to crater because it didn't quite hit their EPS estimates? No, I think this was a pretty good earnings. I think this was just about what was expected. And I think as an investor, I'm pretty happy with some of the things they seem to be focused on. Now, a couple of things that I pointed out that they talked about. They talked about renewables. This is an oil and gas company, first and foremost, and that is the most important thing they do by far. But having a little bit of thought as to, okay, how can we make ourselves look and potentially get ourselves in a position to be positioned for a future where oil isn't as important? And if they continue to invest into these renewable sectors, even if they don't make huge amounts of money now, you never know. Maybe one day that'll be the best investments they ever made. Other things I love to see. The diversification sort of geographically. I love to see that Enbridge is not just sitting in Canada, focused on the Canadian oil market, that Western Canadian sedimentary basin, but instead they've been investing heavily into the Permian Basin. I think that's huge. I think that's going to be huge because depending on what happens next week, we might see a huge amount more expansion in the Permian Basin in the short term compared to what happens in Canada. And because it's so much cheaper to get oil out of the Permian Basin, it's become a place that's much more valuable to these big oil companies to invest into. So there's more demand for somebody like an Enbridge there than there is right now in Western Canada. Now, I'm still bullish on Western Canada, obviously. And Enbridge is obviously still running a huge amount of their company in Western Canada. But it's always nice that if the Permian Basin is going to be a winner, Enbridge wins too. That's sort of huge as an investor. And so talking about those two things, as well as saying not only are they able to continue to invest into huge growth opportunities, but they are aware of how those investments present risks. They've sort of seen the warning signs of the last couple of years with these high interest rates and the struggle that so many debt-heavy companies went through, and they understand this, and they're telling us as investors, hey, we get that this is not the safest move, and so we're going to limit ourselves to this, hopefully, regardless of what happens in the next little while. I think that's also huge. And talking about their sort of ability to be a good investment in all market conditions, through cycles, it's awesome to me. So I want to compare them to a couple of their peers here just at the end. Talk about how people are doing. Enbridge sits at a market cap of almost $90 billion. They're looking at a revenue 3-year compound annual growth rate of about 1%. 5 years is actually down a little bit. We compare that to some of their peers. CNQ revenue 3-year CAGR is 17%. So obviously Canadian Natural has been growing a lot faster. A lot of that's through acquisition. TC Energy revenue 3-year CAGR is at 8%. They're growing faster. Suncor 17%. Imperial Oil 24%. So they're not growing as fast as these producers. But what I think they really are doing is putting themselves in a position to win regardless of what happens in the industry. These producers are almost entirely dependent on a commodity. And Enbridge argues, hey, we're not. It doesn't matter what the price of oil is to us. We're happy regardless. Anyways, that's all I have for you guys today. I hope you enjoyed this. This sort of deep dive into what Enbridge is telling us through their earnings. What does it say about their company? What do we think about the sort of near, medium, short-term future of Enbridge? Do we think this is going up, down, left, right? What's happening to it? And if you enjoyed this video, you might be interested. This weekend, we're publishing a video where I talk about the newest addition to my large fund, which is my personal dividend growth Canadian investment portfolio, where I talk about investing into Canadian companies, specifically dividend growth companies like an Enbridge. And I'm actually adding another oil and gas company to that portfolio on Sunday. So if you're interested in that, please check it out. And I hope I'll see you in the next one.